Good morning. Welcome to Stock Market Today. It's Wednesday, January 13th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Follow me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider. So U.S. equities were mixed to slightly higher on Tuesday. Value outperformed growth with energy, discretionary, and financials leading. Comm services and tech closed lower on the day. Treasuries were little changed, though finished off the worst levels of the day following a better than expected 10-year auction. Dollar weakened versus the yen and the euro. Sterling, though, was an outperformer. Gold finished down 40 basis points, and the gold bugs are not going to like this, but gold's been a mess for months now. We got off the gold train back in September. WTI crude finished up 1.8% on the day. Now, as we get to the desk this morning, futures are down 10 basis points after Asian equities were mixed overnight. Japan was up just over 1%, while Hong Kong and China did see modest pullbacks. European equities are mostly lower this morning. Treasuries are mixed, with the long end actually outperforming. So we should get some curve flattening here in the early session or early part of the session. Dollar is firmer against the yen and euro. Gold is up 60 basis points. WTI crude is up 40 basis points. To kick us off on Wednesday morning, that starts off with me having, I guess, to sound like a broken clock. Churning action, but the song remains the same is kind of the best way to talk about it. If you look closely at the candlestick on the S&P, it's a doji. S&P has supported 360, then 340. Qs holding above that key level in the near term. Important near term, 300, right? 300 is the level on the Qs where we say this is not false. Now, I think enough time is starting to go by where we can start to say that this is not false, at least not in the near term, but it's still important. If we break 300, you're kind of get yourself stuck into this no man's land between 260 and 300, a little choppiness. And then, of course, if we break 260, the trend is then down and you have to change your tone as far as I'm concerned. IWM, near-term support near 190. Then the 160 to 170 range becomes important. Still see SPY above 340, which means we still have potential to 413. In fact, the weight of the evidence supports that. I think that we'll just continue to follow our roadmap. As much as I would like to be able to say something different, I can't. And I'm not going to make it up. The trend is in place. We've discussed it. If you've been paying attention, you should be on the right side of it at this point. If you've been fighting it, okay, hopefully you've learned a lesson. Obviously, everybody's time frame matters. Let's hit the market in a minute now. What are we writing about in our note today? Well, small caps continue to lead the bullish charge. I do kind of a midweek market update on Wednesdays in my note in addition to my sentiment work. And small caps, another record high yesterday, massive outperformance on the day. You'll see it on the right-hand side of your screen. Commodities continue to confirm the inflation theme. Now we're going to get CPI today, but here's what's interesting, and it's kind of sad actually because it's deliberately misleading in my opinion. But the CPI number excludes food and energy, right? So basically the things that we need to live our lives are excluded from the government number. It's kind of a joke. But we live in the real world, which is why I, for our clients, have been a table pounding bull on the commodity theme for months now, and in particular, the ag portion of it. Now, pull up a chart of corn, wheat, and soybeans. Pull up a chart of the fertilizer companies. Pull up a chart of MOO, M-O-O, the agribusiness ETF. Our clients who have been paying attention to what I've been saying have been able to offset some of these rising food prices and energy prices, hopefully, within their investment portfolio by being leveraged to the inflation theme on which I've been a table pounding bull since July. Sentiment remains mixed. Specs are mostly flat. IPO, there's an IPO ETF. I'm sure you're aware. It's bullish and leading the broader tape, so that's kind of interesting. And futures are a bit of a mixed open today, as I said, down slightly on the S&P. Let's hit our major indices now. Look at the power bars. The power bars still send a bullish message. 6-1 bulls to bears on the Dow, which added 18 basis points yesterday. S&P was flat, 127-49 bulls to bears there. NASDAQ slight underperformer, 20-13. Small caps monster outperformer. Small caps just kind of walking to the beat of their own drum right now. 850-117 bulls to bears on the small caps. Bonds downtick slightly. Energy, your big group, another group that we've been talking about. So for those who've been paying attention, again, the song has remained the same at the market level, but under the surface is where the action is. Under the surface is where you get paid. Under the surface is where you determine who has skill, right? And who's just a benchmark hugger. Nothing wrong with being a benchmark hugger. But if you're a benchmark hugger, there's probably not a lot of reason to listen to my show or read my work or listen to anybody's show or read their work. Actually, you just put your money in a benchmark ETF like the SPY and go about your day. But if you're watching these shows and you're reading the work of myself and a lot of really talented people on the Stock Charts platform, then you're trying to outperform, right? So outperforming means not hugging the bench and being attuned to the shifting rotation under the market. Now, we've been talking about energy for about a month and a half now. Up 3.5% yesterday. A lot of opportunities there. Check out the personality change in ExxonMobil, of all companies. It's been the dog of the group for a long time. Let's hit our stock of the day, Commvault CVLT. Part of the software group. Remember, we looked at, we're bullish software. We spent some time on tech yesterday. Commvault has a bullish rating, strong trend, strong industry group. Overbought, oversold indicator, rounding out of an oversold condition. Solid outperformance on the part of Commvault since early to mid-November. Intensely bullish money flow. Bullish stock outperforming oversold with bullish money flow as it trades near a 52-week high. The trend follower in me likes that. The momentum investor in me likes that. And then we add in the Chaikin model being bullish, near-term oversold condition, and under accumulation as per Chaikin money flow. That sounds like a good setup. Commvault is a name you want to pay attention to. Commvault is in my note today, and I think Commvault is something that should be on your radar screen. Let's take a look at our sector tracker now, movement in the last 5 days. Energy, fins, materials at the top of the list. Those three sectors should be familiar to you all who have been listening to me for a long time. Discretionary. Remember what I said now, discretionary has a whole new makeup. For a long time, discretionary was powered by Amazon. Amazon was 25% or so of the discretionary index or discretionary sector. Discretion, and still huge, but there's a new player in the game in the form of Tesla. So something to be mindful of. Industrials, healthcare, Utes, middle of the road. Tech positive, though lagging. Read Staples, comms, bottom of the list. Remember, the comms came under a lot of pressure earlier in the week following several comm services companies like Facebook and Twitter deplatforming a sitting president. Industry in focus today. NYSE Tech Services, past 6 months, been a nice outperformer, leading the S&P by 15%. Power bar ratio very strong, 11-1 bulls to bears, ranked number 10. Micron, Intel, Baidu are three names that are very bullish, and bullish respectively, that are holdings of a fund that, I mean, I teach a technical analysis class at Baruch College in New York City. I do it on Zoom right now, but this is a textbook uptrend. You know, the early lectures in the semester, when we talk about what's an uptrend, this is it. Higher highs, higher lows, steadily moving up, moving average acting as support to various pullbacks. Bullish fund, 11-1 bulls to bears, strong trend, bullish money flow. Not quite overbought yet, but I mean, just look at the beauty that is this uptrend, right? The cyclical rhythm of it. Right? So we've identified it as an uptrend, right? And then you want to use something like some sort of indicator to give you context within the trend. Are we overbought or over? So look at the rhythm, look at the tide. It really is beautiful. Sorry, when I see something that looks like this, I almost want to, I'm going to screenshot this and probably use it in my lectures when classes resume in a couple of weeks. Let's take a look at what's trending now. Yesterday's S&P 500 gainers and losers. Oxy and MRO were upgraded at Mizuho, so part of that energy theme. And then you catch the added tailwind of upgrades via sell-side bank. Etsy, big spike yesterday. E-commerce names, look at Overstock, were on fire. APA goes along for the ride, as does Diamondback in the energy space. On the loser side of the board, Perkin-Elmer. Didn't see anything company specific there. This is a name that I've liked. I've written up. I think it still looks okay within the trend. Maybe an opportunity here. STE, some M&A activity takes that stock lower. SO, talk of construction delays takes nearly 4% out of that stock. Eli Lilly giving some back after a big pop in the previous day. And Take Two has a bullish rating here at Chaikin Analytics, but KeyBank does not think so. They downgraded the stock yesterday. Let's hit our charts. Sentiment, mixed message remains in place, and by that, it's the same mixed message that we've been talking about for months now. Since the May-June timeframe, the 13-day moving average of the CBOE equity option put-call ratio has been in a state of excess greed. We all know what's going on here, right? The lottery ticket YOLO traders are long calls, right? That's it. That's what's happening. All the while, the VIX won't crack 20, right? So there's a bifurcation there. It's an interesting dynamic at play where the options traders are all bulled up and have been all bulled up for some time. But the VIX remains elevated. Obviously not at panic levels like earlier this year, and certainly not, at the levels of 40 that we saw in the early fall, but still elevated. Still elevated relative to, certainly elevated relative to 16, 17. I mean, relative to any point in the past 5 years, we're still elevated on the VIX. It's an interesting dynamic, and it just is at this point. It's interesting, bears watching. But ultimately, the trend is what's most important, and the trend is what we want to pay attention to. So CBOE equity options traders are uber bullish. The VIX is giving a little bit of a different message, and that's fine. In my note, I actually use a regression line on the VIX. And in fairness, it's trading right at the regression line. So the regression line is rising. Okay. So that's interesting. But we're trading right at it. So I guess for all intents and purposes, in the near term, we're where we should be. Maybe. Okay. I digress. Commodities continue to send the inflation message again. Not to beat this dead horse, but I'm going to. This is DBC. This is broad-based commodities, right? So this is kind of a mix of everything. It's been grinding higher. I've been talking about it since about the $13 range, maybe even higher. Yeah, no, right here. I got bulled up on commodities and the inflation theme back in the early July timeframe. So, okay, fine. Continues to grind higher above the 50-day, above the 200-day. Maybe overdone here in the near term, RSI and overbought conditions. Okay, fine. But what I'm intrigued by is how DBC is rounding up relative to the S&P 500. There will come a time where your money will be better off in commodities than in equities. It happens. It happened starting in 2001, 2002. And lasted a long time. Those super cycles last about a decade. I'm not saying we're there yet, but I'm not saying you shouldn't be watching for it. And remember, I mean, everybody loves equities, but they're not the only game in town. Pay attention to the relative strength. Pay attention to what's going on in the environment in the world. And you might find some other opportunities. And another fairly steady trend, this is the IPO ETF, Renaissance IPO ETF. It just was interesting to me. I highlighted it. Steady uptrend above the 50, above the 200, RSI in bullish ranges, and massive outperformer. That's going to wrap us up. Take us for a test drive. I'm back with you tomorrow. Have a great Wednesday, everyone.